Hi everyone, I'm Joana Colucci from the Department of Agriculture and Consumer Economics at the University of Illinois. Trade disputes often seem like short-term disruptions in global markets, but history can tell us a different story. Even temporary shocks can have long effects on agricultural trade. In today's video, we'll look at how U.S. trade policy has potentially influenced global grain markets, from the 70s soybean embargo to the US-China trade war more recently. Before we get started, don't forget to subscribe to the farmdoc channel for more updates. Let's start with the soybean embargo in the 70s. In 1973, one El Niño event off the coast of Peru devastated the anchovy harvest, which was then a key source for animal feed. The spike in demand for alternatives like soybeans drove prices up, just as the Nixon administration was dealing with inflation. In response, President Nixon imposed one embargo on soybean exports. The embargo persisted only for about 4 months, but its impact was longer. The European community, a major buyer of U.S. soybeans, began offering large subsidies to boost oilseed production within Europe. Japan, which depended on the U.S. for 90% of its soybean supply, also made strategic movements. In 1974, Japan established the Japan International Cooperation Agency and launched large-scale investments to support soybean production in Brazil's Cerrado region, an area that until then was considered difficult to farm due to the poor soil quality and lack of infrastructure. The Japanese program had limited impact on soybean production in the 70s, but it helped the Brazil's agricultural growth in the years that followed. This effort, along with continued support from both public and private sectors, continued for about 2 decades, resulting in billions of dollars in investments. Today, more than 60% of Brazil's soybeans are grown in the Cerrado region. Since the late 70s, Brazil's soybean area has grown sixfold, from 19 million acres in 1977 to a record 117 million acres in the last crop season. In contrast, U.S. soybean acreage has increased by 1.5 times, rising from 58 million acres to 87 million acres over the same period. Another event that potentially influenced global grain markets is the U.S.-China trade conflict, which began in 2018 and escalated again this year under Trump's second term. The United States used to be the world's largest soybean exporter. In 2013, China became Brazil's largest agricultural trade partner, and Brazil surpassed the United States in soybean shipments for the first time. Since then, Brazil's share of global soybean trade has continued to grow, with Brazilian soybean exports reaching a record 3.8 billion bushels in 2024. At the same time, American soybean exports fell to 1.8 billion bushels, less than half of Brazil's volume. Together, the United States and Brazil supply over 80% of global soybean exports, while China accounts for around 60% of total soybean imports. In 2018, the first year of the trade war, Brazil's share of soybean exports to China peaked at 82%, while the U.S. share dropped to just 18%. By 2024, China accounted for 73% of Brazil's total soybean exports. Although China's share of U.S. soybean exports has since recovered to around 50%, it remains below the pre-2018 level. In 2024, imports made up 84% of China's soybean supply, with 67% of those imports coming from Brazil. While correlation does not equal causation, it's clear that trade disruptions around key commodities can lead to long-term consequences. It's still too early to fully understand the long-term effects of the most recent trade and tariff dispute with China, but the 70s soybean embargo and the first round of trade war offer examples of how such events can influence global markets. For more insights on this topic, check out the full article on FarmDoc Daily. There is a link in the description below. Thanks for watching, and don't forget to like the video and subscribe to our channel for more FarmDoc updates. See you next time!